Welcome to the Compass series of conversations with leaders charting the course in impact investing, and thank you for joining us. I'm Ben Thornley, and we're excited at Tideline to be co-hosting today's Compass series alongside our friends at Impact Capital Managers, the network focused on scaling the private capital impact investing marketplace with integrity and authenticity, which is a mission we very much share. I'm thrilled to be joined by my co-moderator, Diane Kulju, ICM's Director of Impact Management and Research, as we formally launch our new joint report, New Frontiers in Value Creation. We're grateful also to be hosting a fantastic group of panelists, and we'll be bringing them into the conversation shortly. But first, I would like to invite Diane to share more about our work together in the last year. Welcome, Diane, and thank you so much for ICM's partnership.
All right, thank you, Ben. It's been really a fantastic partnership, and we are so excited to be sharing what we believe will be an incredibly useful tool for impact investors to add to their repertoire when discussing their unique value add during the investment holding period. So again, I'm Diane Kulju, the Director of IMM and Research here at Impact Capital Managers. ICM is a membership network representing over 115 private capital impact fund managers who collectively manage over 100 billion assets under management. And we're a field-building institute helping to grow the market with authenticity and integrity via our research initiatives, our Mosaic Fellowship program, and plenty more. And at ICM, we focus on the segment of the impact investing marketplace where investors seek both meaningful impact and superior market rate returns, which has been the impetus behind our Alpha and Impact report series. The first report in the series was published in collaboration with Tideline in 2018. This first report was called the Alpha and Impact, and it identified 10 unique drivers on how impact objectives can enhance financial value for investors throughout the entire life cycle. Then on the second report, Strengthening Outcomes, we published that last year in collaboration with Morrison Foerster, and this focused on how investors realize value at exit. So building the evidence base and demonstrating correlation between impact and financial value at the moment of exit. And then this report that we're launching as of yesterday is the third in our series. It zeroes in on the investment holding period. We think, impact investing isn't just about choosing an impactful investment at the start or measuring the impact at the end. It's not just a passive process, but truly an active one, contributing to amplifying and improving impact while you're holding it. So this third report is designed to create a framework to explain and categorize the unique management traits and activities that impact investors are already doing and already using in their own practices. But we hope that, by formalizing these concepts, it will help improve investor strategies and enable stakeholders throughout impact investing to use them to establish a common language and build upon them in the coming years in ways that help us understand how better impact really can mean better business. Before we get started, just lastly, a warm thanks to all of those who supported this research. In particular, thank you to the funders of this research, the Annie E. Casey Foundation, Builders Vision, the Ford Foundation, and the W.K. Kellogg Foundation. Thank you as well to the ICM members and the other funds who participated in this research and gave us their time and insights. I'm so excited that you'll get to hear from a number of them today. And with that, I'll turn it back to Ben to dive into the research.
Thanks, Diane. It's been such a privilege to work with ICM on the research for me personally and for my colleagues on the research team at Tideline, Alok Patel, Caitlin Fitzsimmons, and AJ Sanchez. As we move forward with this Compass series, we'll be touching on a number of key concepts in the report. So I wanted to take a few minutes to introduce some of the highlights. The report includes a number of new terms. Financial materiality of impact, meaning the specific ways in which enhanced impact drives enhanced financial performance. Sources of value creation, meaning this stakeholder focus, intentionality, and unique impact networks, expertise, and data that investors use to create impact value. Impact value creation modalities, which are three categorically different types of interventions that we'll come back to in a minute. And finally, the visibility of impact opportunities, which speaks for itself. Approximately half of the impact value creation examples in our case studies were more visible, and half were more obscured and required some real expertise and effort to uncover. We made our best efforts in the research to link specific impact value creation initiatives to specific drivers of financial value For ICM members who are universally pursuing attractive market rates of return, understanding the financial materiality of impact is a critical first step to any impact value creation strategy. The three impact modalities we discuss in the report are growth, systems, and transformation. We hope this simple taxonomy will make it easier for investors to communicate the focus of their efforts, driving or shaping the growth of inherently impactful business models, influencing how a business operates through very targeted systems interventions, or pivoting a business toward impact through transformation. Finally, the report includes an overview of the 7 concrete impact value creation levers that are being deployed by our case study subjects and others in impact investing. Investors can use these 7 levers to create an impact value creation playbook. So we appreciate there's a lot to digest and hope you access the report online and begin to test the ideas. But who better to help us take the first bite than those we are so honored to have featured in New Frontiers, our case study subjects. Without further ado, it's my great pleasure to invite 5 leaders in impact investing to join us. We'll reserve time for viewer questions toward the end of our panel, so please do use the Q&A function in Zoom to quiz our guests. Humera Fires is a mission investment manager at the Kellogg Foundation. Humera leads the strategy and performance of the Foundation's $100 million mission-related investment portfolio focused on social impact and racial equity. Prior to Kellogg, Humera was a vice president for global sustainable finance at Morgan Stanley. Catherine Kitson is a manager impact at EQT Group, responsible for building out EQT's approach to impact measurement and management, in particular within EQT Private Capital. She works closely with cross-functional teams to underwrite impact cases that are collinear with commercial cases and to drive impact value creation. Hope Mago is a partner at HCAP Partners and on the board or actively engaged with half a dozen of HCAP's portfolio companies. Hope's also the chair of the board of directors of Impact Capital Managers. Prior to HCAP, Hope worked at the Reserve Bank of Zimbabwe. Pete Murphy is a senior director and head of ESG and impact at Nuveen's private equity impact investing business. He oversees integration of social and environmental considerations into investment decision-making, and prior to Nuveen, worked at the Global Impact Investing Network. Josh Moskowitz is director, financial access and impact partnerships at Citi, where his responsibilities include tailoring post-investment support to help grow the portfolio of early-stage startups that are part of the $500 million Citi Impact Fund. Thank you all so much for joining us, and thank you for opening up your organizations to the scrutiny of the Tideline and ICM research teams. Welcome. Humera, my first question will go to you. You come to this conversation wearing a number of hats as a practitioner of impact value creation in your own right with Kellogg, as an allocator interested in the value creation work of your underlying investors, and as a market building organization. To set the stage, how do you envision some of the new ideas and organizing frameworks in the report helping with Kellogg's mission-driven investment program?
Yeah, thank you for having me, and to Impact Capital Managers and Tideline for your continued work in building the impact investing field. At the W.K. Kellogg Foundation, children are at the heart of everything we do, and embedded across all our work is a commitment to racial equity and racial healing. And so within our impact investing portfolio, we look to increase access and opportunities for communities of color and access to capital in particular. And in the 17 years since we made our first impact investment, we've committed more than $310 million for both financial and social returns. So as we've invested across the spectrum, and to your point, Ben, wearing a number of different hats as direct investors, as limited partners in funds, and as vocal advocates in the impact investing field, I think we have a sort of bird's eye view on the ecosystem. And so, as Diane mentioned at the outset, the longest part of the relationship is the holding period with these investments. And now I'm thrilled to have a common framework for impact value creation. I think this is going to be enormously helpful. For me, I think this helps me organize and structure the support we provide to specific investments in the portfolio. It helps me have a common language as an investor to communicate with our investees and our fund managers as they evolve in their impact and business approaches. And it also helps me make sure that we know what role we're playing in the field in the context of our peers, partners, and the emerging players.
Thank you, Humera. Appreciate that. And I'll turn now to Pete. Pete, we've introduced a number of new concepts in the report, including the modalities of what we call growth and transformation that show up in Nuveen's case study. How do they help at a high level to explain what Nuveen's actually doing in your work with portfolio companies, further to Humera's point? There's undoubtedly some art in impact value creation, but are we ready as a field to begin to give more definition to the science of impact value creation?
Awesome. Thank you so much, and thanks to Tideline and to Impact Capital Managers for having me and for this work. So very quickly, Nuveen is a very large asset manager. I sit on our growth equity impact investing team. We have about $1.5 billion in assets under management focused on driving an inclusive transition to a low carbon economy, and we're growth equity investors. So sort of investing post venture capital and pre-scale. And I mentioned that because one of the modalities, which is growth, has been really core to sort of our approach to both underwriting transactions and to engaging with our companies, over the last 10 years or so that we've been in this market. We look at our businesses from a revenue alignment perspective, right? So 95% plus of the revenue of the business has to be generated from a product or service that generates a social or environmental outcome. And so in that way, really any of the engagement that we do to drive commercial performance with our business, also generates, social and environmental results that are incremental to what otherwise would have occurred. And that's obviously by design. But I think what's really useful about this framework is that, it sort of pushes us to think about and categorize how we engage with our companies beyond just trying to improve, overall performance at the business. And we've done a lot of work with our businesses where we sort of underwrite to a social outcome to help them understand how they can help their low-income consumers actually better prepare for the physical impacts of climate change, or access the cost savings associated with some of the climate mitigating technologies that generate cost savings. And so it's been very useful, I think, to sort of answer the question of why are we doing this engagement? Because the way that we've historically, sort of categorized what we're doing is really more tactical, similar to the levers that are sort of laid out in this report, which is like, what are we actually doing? But I think this higher level question of why is really important. And I hope that we'll start to see some sort of adoption of this as like an industry standard framework, so that, makes conversations with our own LPs easier when they ask, how are you working with companies over the sort of, 5, 6, 7 years that you own them? So that's sort of my hope.
Great. Thanks, Pete. And yeah, definitely LPs were a key audience for the report, and the idea of a more efficient matching process, more engagement in the conversations between LPs and GPs. So really appreciate those comments, Humera and Pete. I hope the third modality we call systems, but some people who are reading the report or maybe participating in this webinar may think that that's just another way to describe what many investors are already doing in their ESG or sustainability value creation. How, in your mind, and for HCAP specifically, is it different? Like, what makes a systems approach truly an impact value creation effort?
Thanks, Ben, and thanks to the Tideline and ICM teams for having me join this panel. I think to level set for our audience, I just want to recap what Ben mentioned earlier. When we're talking about systems modality, we're talking of those systemic interventions that are implemented to impact a company's operations, the workforce, or value chains, often really with the goal of shifting industry norms, right? And so for HCAP, our approach is different from what we see many traditional investors doing in a couple ways. I think the most important is our primary objective and intentionality. So really for HCAP, our primary objective as an impact investor is we're not only looking to generate financial returns, but we're also looking to generate positive social and environmental impact. So we believe we can only drive sustainable impact by delivering on both these goals. The second key area for us that differentiates sort of impact investing from your traditional investors is really the scope and focus, right? So for impact investing, where you find most funds are specifically targeting the intentional allocation of capital towards those investments that generate measurable positive social environmental goals. Whilst your general investors might have a broader range of factors that they're looking at, and impact may not be a key component here. The third piece is around measurement and metrics. So we place a strong emphasis on measuring the tangible, quantifiable impact of those investments. We deploy a robust impact measurement and management approach. We've been doing this for almost 14 years now. And the metrics we're tracking for HCAP might include things like the amount of capital that goes into underserved communities, number of jobs created in low to moderate income communities. Are we driving greater pay equity? Are we seeing increased diversity across the workforce? So the focus is on demonstrating the actual impact generated by our investments. And then the last piece is really around integration. So we tend to take this systems approach in that we want to make sure the impact approach is really integrated into our investment and value creation process. So we believe that the focus on creating quality jobs inherently drives value creation for our investors. So from day one, we're integrating our gainful jobs approach, which is really our workforce approach into creating quality jobs at the companies we work with. And then we're asking management to sign up and execute the gainful jobs approach. We want them to take ownership of that. And then on top of that, we're doing quarterly check-ins really to make sure, one, they're implementing the approach, but also where can we bring additional resources to bear if there is a need to change the strategy, if there's a need to enhance the approach, if they need maybe outside expertise to help them in executing on that framework. So that's what we think are the key differentiators between sort of our impact approach and what you probably see in the traditional investing model.
Got it. Thanks. So very helpful clarification. Josh, turning to Citi, I think one of the things we've observed in the research, but we didn't prove per se, but we certainly tried to focus on it, was the link between certain impact value creation levers and certain financial results. In Citi's case, for example, we talk about your case study, Wonder School, and the revenue growth that was created by Citi's support for branding and marketing. To what extent do you see the connection between impact value creation and financial results clearly and unambiguously? How much is that a part of your work at Citi?
Thanks, Ben. So the Citi Impact Fund invests in double bottom line companies that are solving really tricky and thorny societal problems with a focus on those that have a particular impact on underrepresented communities. And I say that because, we're focused on the economic growth of the companies as well as the impact that the companies are having. Commercialization is not embedded as a criteria for why we are making investments. And commercialization is one very direct way to measure financial results, because if you're a buyer for a company, that's kind of very clear. So what are other ways and resources that we can apply from a value-add platform that we are seeing can also provide that direct financial value? So first, you mentioned Wonder School. Wonder School is a platform based in the Bay Area that provides tools for people to start childcare businesses in their homes. So it's a job creator for those individuals, but also it creates greater access to needed childcare and affordable childcare in a lot of communities. So as our marketing team at Citi was working on a national ad campaign to demonstrate the positive impact that we have in communities and supporting local economies, we saw great alignment between the work that Citi does as a firm broadly and the work that Wonder School is doing day to day. And so we included them in a national online advertising campaign. And so when you think about what has that meant in terms of opportunities, including financial opportunities for Wonder School, the ad has been viewed around 90 million times. So you can extrapolate the sort of brand and reputational, awareness and value for Wonder School. And more directly, it's led to 200 leads for Wonder School potential childcare providers to come into their platform. So you can begin to see the connectivity there. Another example, while commercialization is not something that we do with all of our portfolio companies, it's something that we like to do. And last year, Reaply, a company in our portfolio that is a platform that helps companies digitize physical assets and reuse them. So it's good for the circular economy. There's an economic benefit for the buyer, as well as a community benefit, because oftentimes the company can donate those physical assets to schools or local nonprofits. And so Citi became a buyer last year, and we've begun to implement using them in sites and branches across the country. And so that is a very clear example of the financial benefit to Reaply. And one last example I'll give that I think is an interesting one. So Citi is committed to having a diverse supply chain. And one of the organizations that we work with is called the National Minority Supplier Development Council, or the NMSDC, which gives certification to companies for being diverse suppliers. We've assessed our entire portfolio to see which ones might map to the criteria of the NMSDC. And we've been working with one in particular to connect them with the organization, and they're planning to pursue that certification, which would open up a broader network with large enterprises for potential business development. So we use multiple aspects of our platform and always have an eye on sort of what is most meaningful, including potential revenue generation or the financial aspect of the company.
Well, that's great, Josh. Real value and the scale of what Citi can do uniquely. Kat, turning to you, and this is another question I think that came up a lot for us in the research. With large investment platforms like EQT, it can be difficult to isolate what a firm might have done anyway to create value, perhaps again with a focus on ESG or sustainability, and where an impact perspective creates a unique and different type of opportunity. So can you talk to us about how the impact value creation sources we talk about in the research, intentionality, stakeholder focus, networks, expertise, data, how those show up for EQT specifically?
Yeah, absolutely. Thanks, Ben. And just echoing my fellow panelists, I'm really pleased to be here. So as Ben said, I work for EQT, which is a large listed investment organization with some 200 billion in assets under management. That's within our private capital business there. So as a starting point, everything we're doing with impact is built on the bedrock of sustainability integration. With Anticimex in particular, what we have been doing is working very hard to pivot this business towards this impactful biocide-free solution for pest control, which is called SMART. So we've invested significantly to help develop the solution there, and that work has also heavily leveraged the knowledge of our in-house team of technology and digital professionals. And then we've also been working really closely together with the management team to kind of connect the dots, if you will, so that impact really is collinear with the commercial case. And a big part of that has been setting up incentive programs that start with the board, but also go down to the management team and then to the branch managers globally as well to drive growth of that SMART solution. So we've also been working quite closely with Anticimex to elevate its overall sustainability efforts. So last year, for example, they hired a chief biology officer who is super passionate and also helps to provide sort of expert guidance for the company's ambition to form a nature positive strategy. So for us, it's been really important to make sure that integrating impact and operational sustainability across the business through financial incentives, expert advice, and measurement to really bring together all those different sources of value creation.
Got it. Thanks, Kat. Well, I'm going to turn it over now to Diane and pass the moderator baton. Thanks, Diane.
Absolutely. Thanks, Ben. Thank you all. Really fascinating answers so far. With this next set of questions, we're going to dive a little bit deeper into the case studies themselves. We've had some previews already, but excited to get to really look at how this impact value creation happens in action. And Kat, I'm actually going to turn back to you again. So looking at the Anticimex case, which you were just touching upon, there are a number of things about this case study that I found really fascinating, from the, especially the very concerted focus on transformation, to a much more sustainable approach to pest control. And when you're looking at that at EQT, how do you underwrite for the financial value of impact transformation? How do you bring LPs along on the journey when the financial materiality of impact is perhaps a little bit more obscure to start?
Yeah, makes sense. So Anticimex is a company that we've known for a long time. And of course, as a result, we know it really well. We know its intricacies, we know the market, we know the customers, we know the competitors. So with that backdrop, I think we were really able to understand Anticimex's potential to create demand and then influence the broader industry, both consumers and competitors, by encouraging adoption of biocide-free solutions. But for us to actually be able to drive those things, we need to be really clear about that upfront and be clear on priorities as we're building out the investment case, which is just super important in terms of understanding what it's going to take in terms of resources, management alignment to actually drive for that impact. On the client side, Humera made a good point earlier about the need for a common language. I think it's important for there to, it's important for there to, of course, be rigor in this, there's also a need for it to be somewhat simple and understandable. So I think framing it for them often as challenge, solution, outcomes, just in that sort of simple framework, can be really helpful in that regard. It also comes back, I think, to the importance of having evidence and case studies that can really demonstrate outcomes more clearly. And of course, we want to make sure that we're bringing all of our clients and stakeholders along on that journey, a rising tide lifts all boats.
That's great. I see as well in this, even, some of those capabilities of the intentionality, the impact data really coming through in your example as well. Thank you, Kat. All right, turning next to Humera. So the Kellogg case study focused on Acelero, which is a really multifaceted case study. It encompasses the distinct roles played not only by Kellogg, but also by BlackRock and Builders Fund. So what that shows, I think, is that impact value creation can really be a team sport, particularly at the allocator level. And so in that situation, how do you go about ensuring alignment and remaining focused across different organizations on the same drivers of impact value and financial performance?
Yeah, Diane, thank you. I think given that this is now a 15-year relationship, it's worth a bit going into the history of this investment. So we made this initial investment in Acelero at the very early days of our own impact investing journey in 2009. And we also went on to fund some impact research with the National Institute of Early Education Research that proved the effectiveness of Acelero's model to show that the intervention was both successful and impactful. And since then, we've gotten to see the evolution of Acelero as a company and see that through it all, they've maintained sort of a singular focus on providing high quality early childhood services for young children, often the most vulnerable and underserved children and their families. Stepping back and looking at a macro landscape, we looked at our portfolio sometime in the last few years and realized that many of our investments, direct investments like Acelero, and many of the underlying investments in our venture portfolio were growing and becoming successful. And we saw a gap in what the next stage of growth looked like for them, especially as they sought aligned, impact-oriented capital. And so with that lens, we made a selected number of investments in growth and buyout, including an investment in BlackRock's Impact Opportunities Fund, which is a multi-asset, multi-sector fund with a real alignment and mission, promoting racial equity, and its ability to invest at scale was really exciting for us. And so as Acelero sought growth capital to fuel its next stage of its journey, and of course, they were adamant about it coming from aligned investors, making that connection to bio was a natural step for us. And I think and hope that the BlackRock bio team knew what to expect from the Kellogg Foundation. We set this up, we set the stage with them that our expectation was that this was a long-term relationship. I'm held accountable internally to what we learn and what we contribute to each investment we make. And we're really interested in being long-term and active partners. Bio then went on to lead a powerful syndicate of impact-aligned investors, which included the Builders Fund. And having seen what these types of transactions can look like when there aren't impact-aligned investors coming on at the next stage, it's been incredible to see the institutional quality of direction that Bio and Builders have brought, and also the continued and maybe renewed focus on the impact and mission of the company. And that's where I think having like-minded investors at the table can be really helpful. Traditional investors, for example, wouldn't see at this critical stage why prioritizing things like living wages and employee incentives might be so critical. But this board sees the long-term competitive advantage of a stable and motivated employee base, especially in a sector that has a very high level of turnover. And so I'd say my biggest takeaways from this case study were that first, we focus so much, again, as I was saying before, on new investments. and on the exits, but the holding period is the longest part of the relationship. And we really need to continue to think about how we support companies and fund managers through their growth and evolution, which is why this framework is so relevant. And secondly, I think while investors in Acelero, the people around the table all have slightly different mandates on mission, returns, stakeholders, I actually think having that common alignment on impact allows us to collaborate and to trust each other and to leverage our different approaches as an asset. The diversity of thought and perspective in the room really then helps to contribute to a robust governance process and creative approaches for enhancing the bottom line. So it's been a really exciting journey, and I'm looking forward to seeing what comes next with them.
That's fantastic. I think, again, just really the collaboration, the trust that enables, going beyond with other stakeholders rather than just being, individual efforts is fantastic. Okay, great. Next, we're going to turn back to Josh. So my question for you, Josh, is how do you go about institutionalizing the practice of impact value creation at a place where you have so many levers to pull, such as Citi, like the Wonder School example shows? So what would you say where do you say impact value creation sits within the impact fund? And does your work in impact value creation look and feel like a playbook in the truest sense?
Yeah, look, I think you put it well by how do you institutionalize? I think for it to be effective on an ongoing and consistent basis, and getting to the last question about also tracking the financial, impact, the positive impact on the companies, it has to be rigorous. And so it takes a process, it takes a playbook, it takes day-to-day attention, and also tracking. And so where does it sit? We have a dedicated resource where I lead our post-investment support activities, and I collaborate really closely with our investors and the team to assess where we can have the most impact. And I am lucky, our team is lucky, that being at corporation and being a place like Citi, which is global, we have a really tremendous value add offering. And so, I spent the beginning of my time working with the Impact Fund building out an offering, or a menu, as we put it, of 3 buckets of areas where we think we can provide greatest value. And we do it in a way where there are things that make sense for us to be doing. We are a corporation and we are a bank. Certain things are going to make sense for us and certain things are not. The concept of obscure opportunities comes up in the report, and we don't want, if something's obscure to us, we're not the right ones to be implementing the value add. We're going to implement on the things that we see and make sense to us, and where we think that we can deliver. From a process perspective, which is important, and Tideline, Ben and the team, we worked with you all in 2022 on a number of aspects of our strategy and approach, including value add. And from a process perspective, once we make an investment, our lead investor, who will have been working with a prospective company for many weeks and months, will introduce the company to me, and I will lay out our offering to them. And we've seen great success with our investments from last year, where rather than being kind of responsive or reactive, we can be proactive. And here are the things that we can do and that we're good at. Let's talk about them. And it really sparks a conversation. And part of this process now has even gotten to be pre-investment, where the Tideline team has given us an approach to try to map out and score the potential for value add even before we make the investment. Just 2 last things. I think people are really important in this process. So while we can talk about capabilities and solutions at Citi, it all comes down to people. And so we spend time building what we call internal champions. There's a lot of things going on at a large company, and so we're educating, informing, and building momentum and excitement. And so when we think about the Wonder School example, in addition to the ad that we featured them in, we heard in a conversation with their founder early on that their childcare providers being homeowners is very meaningful and important to them, because it takes a lot of the risk and inconsistency about having a childcare business in their home. So we were able to collaborate internally with our mortgage team, with a particular group that focuses on LMI families and individuals, as well as our community relations team, which has relationships with national and local nonprofits that are also focused on creating access for home buying. And we created a webinar series in conjunction with Wonder School to provide tools for them to get on the path to home ownership. So a case where we're not commercializing, but we're drawing upon the best that we have internally to provide value to a portfolio company.
That's fantastic, Josh. I really think you have such a clear articulation of your playbook, down to obscure opportunities aren't the ones for us. And these are the business units that we can activate. And that's what we really hope for in this report, that others can take those same tools and really lay it out clearly for themselves and the other stakeholders they're engaging with. Thank you. All right, next turning to Pete. So another case study we love is Nuveen's Annapurna case. It's such a really concrete example of investor rolling up your sleeves, bringing a unique perspective in to help innovate in product design and development. So I'd love if you could share with us quickly the story of Annapurna's genesis within Nuveen. In other words, how did you recognize the impact value creation opportunity and connect that opportunity to financial performance as well?
For sure. Yeah. So I think I mentioned earlier, our focus is really on this sort of nexus of financial inclusion and climate change mitigation. And sometimes we invest in businesses where they're sort of already tackling both. They're already helping the low-income consumer transition to a low-carbon economy. Sometimes we enter into a transaction where there's really a focus on one or the other, and our value creation approach is really to work with that company to help them incorporate the other. And Annapurna, as well as a couple of other financial institutions in our portfolio, are good examples of that. Generally, they are financial institutions serving low-income consumers and small businesses in emerging markets, mostly in South Asia and India. When we sort of entered into Annapurna in 2021, and then another example, Kanara, in 2022, we recognize that these businesses are operating in areas of India that are really exposed to the sort of physical impacts of climate change. And as temperatures increase, 136 million people worldwide are expected to be pushed into poverty by those physical impacts by 2030. And so this is a real sort of critical issue for those individuals who we're obviously investing to try and serve, but also a real sort of business risk to these financing businesses who are providing them with loans. And so we actually entered into this engagement really with sort of a climate risk management lens at first. And did a sort of physical risk assessment to try and understand sort of portfolio value at risk of these, books of these, low-income consumer lenders. And that's really challenging. Like if someone asks you, what's the sort of physical risk exposure of my, apartment building in, Florida, like that's one challenge that's really hard to sort of answer. But when you add the sort of lens of, okay, these are small businesses owned by people living in reasonably rural areas, they're taking out loans of less than $300. It's typically smallholder farms or handicraft production. It just becomes even more challenging to sort of answer that question. So we spent a lot of time working with the companies to do that. And then, to the company's credit, I think they recognized these risks and said, okay, well, how can we actually proactively build products and services that can address these? And so obviously that's music to our ears, and we, as well as a number of other shareholders on the cap tables of these businesses, really sort of partnered with them to say, okay, well, you can help this consumer with, generating energy in a more, sort of environmentally friendly way. Rooftop solar is sort of the primary example. You can help them improve mobility with access to electric vehicles. You can provide information about, sort of early warning for large natural disruptions and disasters, cyclones, droughts, et cetera. You can provide information about, which crops are most resilient to the sort of physical impacts of climate change, et cetera. And so, that's really where, it came from, was the business sort of coming up with these ideas largely on their own, and us sort of helping them to implement where necessary and rally stakeholders, get other shareholders on board, et cetera. I would say that the link to financial performance, really quickly, is one, that they are more effectively managing these like very material financial risks to the business, which are the result of climate change. And two, they've developed new business lines, which are growing, and candidly, which are sort of first in their sector, first in their class. And so they're really attractive to follow-on investors. The sort of like green financing units at some of these businesses are, in the pitch decks as they go out to raise follow-on capital and eventually as we start to think about exiting. So we think there's a real, we don't have concrete data yet, but we think there's a real sort of, margin or multiple improvement that we'll get at exit. I'll stop there.
Great, that's fantastic. And I love yours is one of the, along with actually Anticimex, one of the examples of the transformation case as well, where you're bringing in, yours is a dual modality, which I think is great to see as well. It's not all examples are single modality, but you use that growth while also transforming to expand products and services and manage risk within an industry. So Fantastic. All right. Lastly, Hope, turning to you on highlighting HCAP's investment in Better Night. So again, we're focused on sleep disorders. This case study demonstrates HCAP support first, again, looking at a dual modality for Better Night's growth, and then second, through systems, through the growth strategy, focusing on telehealth, and through the systems, focusing on quality jobs. So what would you say made it possible for HCAP to create that value? In other words, what are the capabilities, active management approach, or focus that HCAP brings?
Right. So, with the Better Night investment, I think it's important to sort of lay out what our key themes going in were. So really, there were three things we're looking at. One was, how do we increase access to care? Two, how do we lower the cost of care? And three, how do we drive enhanced quality of care? So overarching, that was our investment thesis. And a couple key stats on how we've impacted patients. So last year, we provided services to about 68,000 patients, up from 25,000 when we first invested in the company in 2019. Last year, we set up 26,000 new patients with sleep apnea devices, up from around 10,000 in 2019. And then during our investment period, we've managed to increase revenues 3 times since the time of our initial investment. Now, how have we achieved this? The first approach was we went and invested in a telehealth platform. And the goal was really, how do we drive scalability and broaden our presence across the country, right? And that speaks to the increased access to care thesis. And part of that was when we first met the company, they were conducting 100% of their sleep tests in 4 physical sleep clinics. People had to book time up to 2-3 months ahead of their sleep exam. And we found that was not very conducive, right? If you're earning a low to moderate income wage, can you really afford to have, take a day off from work, spend the night away from home, undergoing a sleep test, right? So we've now gone to 100% of our sleep tests are done at home, which really has driven increased access and convenience, primarily in underserved communities. We also, by transitioning from a sleep clinic setting to home sleep tests, we've lowered the cost of care from about 8.7 thousand per patient to now it's around at 1.2 thousand. And then we've increased our footprint. So we've gone from 1 state in 2019 to now we expect to be in 16 states by the end of 2024. And then more importantly, because we do really think the workforce is important in scaling the business and achieving these results, our headcount has increased from about 145 employees at the time of our initial investment to we expect to be over 600 employees by the end of this year. So all those things are how we've sort of achieved this in terms of creating value, not only for our patients, investors, but also for the workforce. So the 3 things we leveraged were technology. So as I mentioned earlier, we went in and invested in a nationwide telehealth platform that allowed us to scale rapidly. We also invested in a population health software tool called Clarity Care. It's proprietary to the company, but what it allows us to do is drive what we call exception management, which has driven up our long-term adherence and compliance rate. So now we report about 67% adherence rate versus 33% for the general sleep apnea industry. So driving quality of care and compliance was really important to our thesis, and this is part of how we impacted it. And then the last piece was really focused on the workforce. So we understood that for us to be able to scale the business and continue providing quality care to the patients we had to be able to retain our best talent, but also recruit clinical staff. Our clinical staff has grown about 3x during a time when I'm sure most healthcare investors will attest that finding and recruiting healthcare workers has been really challenging. And this has been possible through our implementation of the Gainful Jobs approach. And it's important for us because it's a key component of making sure not only are we empowering the workforce, but we're able to keep everyone feeling empowered within the workforce, feeling part of the journey. And then we also make sure they participate in the upside of the business. So some of our companies, we put in stock option plans, and other companies, we put in transaction bonus plans, which are broad-based. And this allows every employee to participate in a successful outcome when we exit that business. From the growth perspective, 2 of the other things we did was initially brought in some consultants to help with the technology roadmap, but we also brought in a former CEO we worked with on another company who became the chief commercial officer at Better Night, and he really helped build out the sales team structure and mapped out the sales territories and MSAs we wanted to be in. And that really sort of helped accelerate our expansion into additional territories. And then the last thing really sort of to tie this all in is when we first met the company and were building out our Gainful Jobs roadmap, management's goal was really sort of retention, right? But because of the execution and implementation of the roadmap, we've actually been voted as one of San Diego's top workplaces for the last 3 consecutive years for the period ending in 2023. So when we tie it all in, we can then say a lot of the value creation that has taken place has been as a result of implementing the things I just went through.
Great, thank you, Hope. Again, I love the foundation of your gainful jobs approach, but then coupled with many other levers as well to make change. Fantastic. All right, now we're going to be turning to the audience Q&A portion of our session today. So starting off, we have a lot of good questions in here. From an anonymous attendee, how far do the panelists experience perception of a trade-off by investors and investees between impact and commercial/financial return, particularly where there is risk of mission drift to serve less vulnerable segments of the population over time? And I would leave that open to the floor for anybody who would like to jump in.
I can start. For us on the mission-related investment portfolio, we are not making a trade-off. We are seeking market rate returns while maintaining a focus on racial equity. And we invest in companies where the impact is so deeply embedded that the success of the company means growth and scale of impact as well.
Yeah, same. For the City Impact Fund, we have societal goals and we're investing in companies along a number of verticals like financial resilience and climate resilience and workforce development, where we know that the nature of investing in those companies is going to help drive those societal benefits and impact. And we think there are a lot of companies in those verticals that also can perform very well. And so we're screening for both of those double bottom line elements as we make investments.
Yeah. I think the one thing I'll add is that perception of a trade-off, you typically find it in asset managers or asset allocators who are really early in their impact journey. So they're still sort of starting their foray into learning about impacts. And that's kind of the education piece we always have to sit through and provide, right? Is there's no trade-off. This is why, these are the returns of the funds, and this is how we deploy our impact approach. And so the more we have those conversations, the more they sort of understand there's no trade-off. But the first conversation, there is that perception.
Yeah, and I would just add, I mean, we are a private equity manager who's managing capital of LPs that are all retirement service providers. So we have fiduciary duty to normal people who need this money to retire, and so we're very focused on this. We are serving, investing in companies that serve the low-income consumer segment. And so a natural question might be why don't you move up the credit spectrum? It might be easier. But the reality is that these businesses are created to solve a problem. And so the sort of special sauce that they have, the thing that they do well, is solve that problem for that consumer in a way that is profitable, scalable, et cetera. And so, I think it just speaks to the sort of need to screen companies really very early on for that sort of differentiation and that ability to build a model that actually can be grown. Because I can imagine a world in which you don't do that, in which there are sort of incentives to move up the credit spectrum or into an adjacent market that isn't as impactful. But it's really about sort of making sure that business was created actually to solve that problem at an early stage.
Fantastic. All right, moving on to another question. Glad to hear from each panelist about impact value creation. How do each of you value or quantify your additionality beyond a narrative?
I'm happy to take that. So we've, over the years, have been evolving. We've been on this impact journey for since the founding of the firm. So it's been about 20 plus years now. In 2013, we actually transitioned to a platform called Tablecloth, really to help really quantify our additionality and really start tracking metrics. Ben knows we've been working with them on tracking and reporting on metrics going back to 2009. And really, it's an important part of telling that impact story, right? Because there's a perception of, okay, there's a lot of good stories out there, but show me the metrics, right? And so I think impact management and monitoring and reporting continues to be a topic of discussion with investors. But we've always said with each fund, we want to sort of enhance our reporting and the metrics we show our LPs. We're just right now transitioning to another platform called UpMetrics, which allows us to give our investors additional visibility into our metrics and really sort of make that storyline around quantifying metrics and what we're doing from an impact perspective much more easier for the different LPs who have obviously different mandates and focuses, for them to really sort of tease out that story, right? Without us having to, get on a call and have to walk them through each metric separately.
Yeah, and I think to Ben's earlier point, there's definitely both art and science. It's becoming much more science, and there is much more of an ability these days to point to specific numbers and talk about that in a concrete way. But the reality is that I think from a scale perspective, it will remain a bit of both. It's much easier, I suppose, to Hope's point, than having to go through every single one every single time. Needing to find that balance is important.
Where we're not yet at is being able to put a dollar amount on all of our value add efforts. Maybe we'll get there, but we do think about it really carefully, because we do have limited sort of resources in terms of our team and engagement. We really have to prioritize what we're doing to what's most meaningful. So we think about what's high value, medium value, or lower value. So, getting a fintech in our portfolio onto our no-fee ATM network nationally in the US, high value. Creating an ad for Wonder School, high value. Placing a founder and CEO on a panel at a Climate Week event, here at the firm in front of ecosystem, partners and a network, medium value. So we're thinking about it sort of generally as we think about applying our resources.
I think it's also about choosing the right metric for the right company. It's hard to tell that story, it's often difficult anyway, to tell a consistent story across a more generalized pool of investments with one data point. So finding the right data point to tell the story is key as well.
Yeah, for us, 17 years of investing across many different sectors, geographic regions, asset classes, and levels of impact, this has always been custom, and I think to a certain extent will continue to be. I think the three questions that we're answering in terms of value creation is, how are we helping deepen the impact, and particularly the racial equity lens of our investments? How are we helping them be competitively differentiated in generating alpha and financial returns? And then how do we help them scale and grow and sort of amplify their voices using our own platform? So trying to create roadmaps and perhaps cohorts in our portfolio, but still early days.
Absolutely.
Diane, we probably maybe have time for one more quick question, and then we'll move to our final lightning round.
Pete, did you have a comment though? I saw you come up. I want to make sure you get a...
No, all good, all good. One more question. Let's do it.
Great. I mean, great points about just, the realities of IMM at this place, managing, right-sizing resources, getting things accurate. As much as we might want to put dollar values on everything, we're not always there yet. And so I think a lot of really fantastic points. I guess last question, lots of fantastic questions. Thank you all for inputting. But last one for today, from Ethan Stambler: how can we catalyze and support smaller and/or non-impact focused PE firms to identify and execute on similar impact-driven value creation opportunities where they are financially material?
Yeah, I mean, from my perspective, I would just say that the thing that we can most do is document how they are financially material and provide case studies like are in this report. People will follow the money there, I think, if there's a clear, and, in an ideal world, that would be more quantitative than we're able to provide today. But I think this is a good start.
Might be a bit of a controversial take, but I think actually the regulation can be a helpful lever here. Things like CSRD in the EU and taxonomy. So to Pete's point, being able to get clearer on the different revenue streams and how value creation opportunities related to impact might really be material. I think there will actually be value there in the long term.
Thanks, Kat, and thanks, Pete. And there was a question about the definition of impact value creation, and our focus in this research has been working with investors who are targeting a commercial market rate of return. So their impact value creation efforts have generally been linked to that particular objective. But certainly impact value creation can exist with or without a commensurate focus on the financial outcome that would result. But regardless, determining the financial materiality of impact will be important just to understand the ways in which impact value creation can be helpful. But to move to our last lightning round of questions before we sign off, and thank you all again so much for joining us. So we're just going to go down the line with the question, as you've looked at the report and the 7 impact value creation levers, and our readers will have the opportunity to review those, which among them is an area you yourselves and your organizations would like to focus more on in the coming years? Why don't we start, Kat, with you, and then I'll go down the line.
Sure. So I thought about it and I couldn't choose just one, so I chose 2. So I was thinking primarily on the impact positioning side. So we are thinking quite a lot about industry transformation and companies' ability to demonstrate to a broader market what the impact of their particular product or service might be. So that's something we're thinking a lot about. And then I mentioned it earlier and so did a few other folks, but on the incentive side, I think we're finding that is really key to get right. And often these topics don't sit squarely with just one particular person or one particular function, and not necessarily just the sustainability responsible at a company. So I think making sure that everyone is all clear on what the focus is and going in that same direction is also important.
Thanks, Kat. Pete, to you.
Yeah, I would say similarly, impact incentives is important to us. With our second fund, we've introduced an impact-linked carry structure for ourselves, and so really are thinking about how can we extend that sort of impact-linked incentive structure down to the management teams of the companies we invest in.
Awesome, thanks, Pete. Humera?
Yeah, I wish I had chosen and been able to choose more than one like Kat. But obviously all of these are important. And I think depending on the investee stage and type, and also your own expertise and capacity as an investor, there's a lot of different levers you could lean into. For us, the focus on communities is central to our work. And so to be able to, in this case study, partner with the likes of BlackRock and the Builders Fund to help and scale such a great company like Acelero was a real privilege. So I will say number 6, aligned capital. Access to aligned capital has been a really pivotal way that we've been able to add value.
So thanks, Humera. Hope?
Yeah, I went with market building. I think, given all the work we do with impact capital managers, the conversations we have with either first-time funds or emerging managers or, smaller funds that are looking at sort of entering the impact investing space, we think expanding the addressable market for impact products, services, funds is important, right? Since the founding of ICM, impact investing ecosystem has scaled significantly. But when you look at it against sort of what the total addressable capital that's out there, was still a very small allocation, right, in many asset allocators and investor strategies. And I think we have an opportunity where impact investing can continue to play a key role. And so the more capital we can transition into the space, I think there'll be good outcomes for everyone involved.
Right, thanks, Hope. And Josh, the last word.
High stakes. I also went with market building. We're tackling really tricky, complex societal issues and trying to advance systems change, and we cannot do it alone. And so we need to be working with other partners, sharing best practices. We're co-investing, so we are obviously already engaging with other investors and engaging in the broader ecosystem, but I think always opportunity to do more forums like this, learnings from this report, figuring out how we can align more as investors, because I think that can in turn help to create and support the market building efforts as well.
Awesome. Well, thanks, Josh. We hadn't planned that, but that was the perfect ending to our conversation. So you did well, Josh. And thank you all for joining us. Thank you to our panelists so much. Thank you to ICM. Diane, your partnership we value so much. Thank you to our funders, the case study subjects in the report. Please visit us at ICM and Tideline. And thank you for joining us for the Compass series today. All the best.